Well, we've brought you this top story today. This is after inflation data dropped yesterday. It's the highest it's been in 6 months. So the Reserve Bank will be watching this very closely, and there is now an expectation, a high expectation, that interest rates will go up in August. Joining me now is Judo Bank Chief Economic Advisor Warren Hogan. Warren, great to see you. So, what do you think? Have you changed your expectations? Because you've been spot on in your predictions of where rates are going.
Yeah, hi Laura. Thanks for having me on the show. No, I haven't changed the expectation. I thought we had enough information in late April with the Q1 CPI and importantly the strong employment numbers that the RBA just didn't have that cash rate high enough to get inflation back down to target. And as the last 2 months have rolled on, we've just got more evidence of not just the strength in employment and therefore the demand in the economy, but obviously this inflation is clearly not falling, which is what they need it to be doing, falling down to their target. But we're getting some hints out of the monthly numbers that it could be rising. And that's a disaster, of course. So, look, the RBA is going to wait for the quarterly figures. But the reason yesterday's monthly number was so important is not so much the number itself, but really the fact us economists now have a lot of information on Q2. We have April and May price data, and we can get a pretty good feel for that quarterly result. And it looks like it's going to be at least 1% or higher. And that's pretty much the trigger that the governor put forward in recent weeks for a rate hike.
So are you saying August is now pretty much a fait accompli and there could be 2 or 3 rate rises still this year?
Look, we had August and November thinking that they would put one into the system, but because they're such reluctant hikers and they want to do as little hiking as they possibly can, they would wait. And then, of course, this government stimulus in the form of tax cuts and cost of living provisions would maybe force them to go again in November. But look, the inflation numbers are pretty bad. It's really unfortunate. It's not good news at all. And I think there's a chance that they'll go in August and September on the view that if they're going to get the job done, they've got to do more than just 25 basis points. I mean, they've done 425. We're getting close, I think, but 25 probably doesn't move the dial on the overall economy. But look, let's see how the data runs. It's not a fait accompli. It's a very high probability. I think it's up around 60-70% probability they'll go in August. But we do have 4 more weeks of information. And I think the key things that could change are the global scene and also the next employment numbers and potentially the retail sales numbers. Because we do know one thing, the RBA is not going to do this unless they absolutely have to.
Yeah, absolutely. And Ross has spoken about the experiment in many ways from the RBA. We've seen how strong those jobs figures are. With 2 rate hikes potentially in the system between now and the end of the year, do you think that 2 rate hikes would have a material effect on that employment figure?
It's impossible to know, to be honest with you and your viewers. I've been doing this for almost 30 years, and this economy is not behaving as we are used to. There's a lot of change in our economy, whether it's deglobalization. Well, the big one for me is demographics, the retirement of the baby boomers, which, we've been talking about in terms of intergenerational reports for 20 years. But one thing that's come through is this concept of dependency, where all those baby boomers have retired, they've got money and they're spending, but they're not working and adding to production in the economy. So we've got a labour shortage. That's a big deal. Deglobalization is a big deal. And look, the energy transition, the rise of AI, there's a lot going on. And of course, everything's resulted in, not just here but overseas, a more resilient economy than we thought. And of course, that means inflation is more stubborn and persistent. So look, we need to keep an open mind about this. But the reality for the RBA and for everyone is that the last thing they want to do is let inflation take hold. Because if they then have to start chasing this next year, I mean, that's essentially what happened in the late 1980s, and that was a disaster. And we do not want to see rates go up by 3, 4 or 5 times, which will put the economy probably into recession. But look, they're just doing what they have to do to keep the economy on an even keel.
Okay, well, we were speaking a couple of months ago around the budget and also anticipating this massive tax cut that's coming for everyone in just a couple of weeks' time. We've also got, those artificial inflation moves by Jim Chalmers and the energy rebate, for example. We've previously heard the governor say, well, the RBA is essentially going to look through those measures. But when it comes to these tax cuts in particular, the RBA can't ignore those completely, can they? Because there's going to be a lot more money in people's pockets.
Yeah, totally. And look, it's not that they see with the cost of living measures, they have a mechanical effect of reducing measured inflation, but they actually don't do anything for inflation. Yeah. So they're going to look through that, and they can do that quite easily with just their spreadsheets. Whereas the tax cuts, what we don't know is how much of a boost that's going to give to the economy, how much of a boost it's going to give to demand, and therefore how much it's going to make this job of getting demand in line with supply and therefore inflation down harder. And I don't think they say they factored it in, but the reality is the economy is tricky at the moment, and we're really not going to know until we see how the economy plays out in the back half of the year. But you're right, they won't be able to ignore it because it'll show up in the data, in the spending data, in the employment data, and then potentially in the inflation data. So the one thing we've got to take into consideration is the weakness in this economy has been driven by pressure on household incomes because of bracket creep, inflation, rate hikes, and that's going to be a big pressure release valve with these tax cuts. So I think it just gives them more confidence at the very least that they can nudge the rate up a little higher in the next few months, and it's not going to push the economy into recession. We shouldn't lose sight of the good news here. Our economy is proving resilient. It's creating jobs. And of course, the recession is nowhere to be seen.